Welcome to MacroHive Conversations with Bilal Hafiz. MacroHive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com. So greetings and welcome, Phil. It's always great to have you on the podcast at the start of the year.
Great. Bilal, real pleasure to see you again, and happy 2023.
Yeah, likewise. Now, there's a lot to talk about.
Year of the Rabbit, of course, I should
Year
mention.
of the Rabbit, indeed. Yeah, the Chinese New Year. And we'll get to China in a moment. But before we do that, let's talk a bit about the US. There's a lot of debate at the moment around hard landing, soft landing, Fed cuts, no landing. And where do you stand on the US right now? When you sort of step back, look at the US economy, what's your overall take?
Well, I think we're in this sort of environment where we've set up the conditions for an economic downturn, but we're not yet seeing it. So, frankly, it's that sort of almost like a phony war type of environment where something's coming. The fact it doesn't appear each week to some extent makes people feel a little less pessimistic and possibly a little more optimistic. But I worry that that's just sort of missing the obvious that's coming down the pike at us. And I think increasingly fast as we go through the early months of 2023.
And I wanted to ask you, what are the signs you normally see running up to a recession? And is this time different because we had this COVID shock and that distorted the economy and we had all sorts of odd things happening this time around? But what normally should you see and how does it compare to today?
Right. So, putting it very simply, part of it depends on the nature of the recession that you're talking about. Obviously, in 2020, one just hit us out of the sky, hit us with no warning. This one is a much more what I would call conventional downturn looming. That's, to quote dear old Rudy Dornbush from the 90s, this is an expansion that's going to be murdered by the Fed. And the murder weapon's already out. The Fed's been bashing us with it. And it's a matter of now sort of having that effect feed through. So where do you look for that? The most obvious point initially is interest sensitive demand. And that, putting it very simply, is housing. But it's also capital spending. And then it's interest-sensitive spending by the consumer. And I think as you go through each of those three pieces in the US context, housing's clearly moved down decisively. I think the interesting thing about this housing downturn is it's been sharper in terms of the quantities involved, but actually it's had very little financial fallout. So it's very different from the last time when the slide was more gradual, but the financial fallout was huge. The other place I think you're seeing clear signs of effect is capital spending by businesses. But there are some important kind of factors there that add a little bit of noise, not the least of which is that although business CapEx is falling, some commercial CapEx is actually improving because of this lagged response to the downturn, to the pandemic. So, commercial construction, a lot of it was frozen during the pandemic and has begun to improve on the private side. And we also got this public infrastructure program, which has begun to kick in. It was passed a year and a half ago, but it's now beginning to improve. So that side of it is I would say sort of 60%, housing's 100% going as it should be. The broader construction sector is more like 65% going like it should be. CapEx on equipment and stuff like that, I think, is beginning to slump significantly as reflected in the durable goods numbers. And then the final one is interest sensitive spending by consumers. And that's even more cloudy because the big item there tends to be auto sales. And they got so depressed for so long because of a lack of supply. And some of that supply is now beginning to get resolved. So you actually have the paradox that auto sales have actually improved as interest rates have gone up. And it's not the latter causing the former. It's simply that, you've seen one of these restrictions from the pandemic beginning to fade. So I think kind of looking through all that noise, I'd say I feel comfortable enough to continue. I've had a view that the economy would dip into recession in the second half of the year. I've had that view now for a few months. Before I thought it would be more like 24, but then the Fed upped the pace of hiking and that caused me to bring it forward a bit. So I'm sticking with that view with a reasonable degree of conviction. What I want to see, this is not not good, but I think will happen. For that view to be realised, I want to see the labour market to begin to deteriorate through the first quarter, and the plainest way that will show up. I mean, everyone will tell you this, and I'm not telling you anything special. It'll show up in an acceleration in jobless claims. So jobless claims will move from the low 200s up towards 300, and then by the middle of the year, broach the 400 weekly limit, weekly level. If that doesn't happen, my view is wrong, and it's a week-to-week way of reading this situation.
And on the labor market, there's a lot has been talked about the level of job openings, that the sort of labor demand is very high, whereas labor supply has been relatively low. So the argument is that we have an unusually large supply-demand mismatch today compared to historic periods. Does that change things for you?
Again, it's, you could argue where we are is more deeply overheated than any labor market we've had, in the last 50 years, certainly compared to the late 1990s and 2019, which was the last time we were at these levels on the unemployment rate. And you could say, well, wage growth has begun to reflect that. It accelerated, and, it's not gone through the roof, but it remains relatively high compared to its history through the 2010s, through the last expansion. And I think what we're beginning to see now, and this is something I've been looking for, I think is quite important, is a sense of companies beginning to say, okay, we overhired in the expansion. I mean, I think there's a natural tendency in this situation where there's a shortage of workers, perceived shortage of workers, to hold on to workers in the initial part of the downturn. Kind of like a hoarding narrative. But I think what's going on here is that companies are beginning to say, well, enough's enough, and it's time to start letting workers go. Now, everyone makes, with their quarterly earnings announcements, big pronouncements about how you're going to lay off 10% of your workforce. But that's now beginning to happen in the tech sector, especially.
Yeah, and then about the tech sector. I mean, when I look at the labor market data, what I find is that there's certain sectors kind of overhired during COVID. So tech, finance, legal services, warehouses, and so the level of employment in those sectors are larger than before COVID. Whereas other sectors, especially in other services sectors, nurses, restaurant workers, hoteliers, and so on, they're below the level that we had during COVID. So does that kind of imbalance, is that different from before? So we could hear about the job layoffs in tech and so on, but that doesn't necessarily tell us anything about the broader service sector.
Yeah, well, I think what you've raised, you're coming back to a point I was making through a lot of last year, which actually ironically is that precisely because we've got some of these structural sectoral changes that have gone on over recent years, we probably ended up with a higher NAIRU, or a higher natural rate, than we had pre-disturbance or pre-pandemic. So there's a shortage of, as you put it, restaurant workers, and to some extent, face-to-face workers. People don't want to do that thing anymore. It's it doesn't have its appeal, and you're not paid enough for it. So I think one of the features of the next few years is actually going to be that we're going to end with a higher perceived natural rate of unemployment there. Now, that was an interesting discussion to have last year when we were talking about how much tightening must the Fed do. And I was arguing a lot more than the market thought, and that view has prevailed, I think. But the point being here that I think the NAIRU discussion has gone a little bit into the background and becomes more relevant when we talk about the next expansion. For example, how much the Fed can cut once we go through this next recession. But at the moment, I think what I'm looking, the key labor issue I'm looking for is the front end of layoffs and the deterioration there, and that will then begin to spiral into a much higher rate of unemployment. I'm projecting the unemployment rate to get up to around 6.5% by the early part of 2024. And that, sounds pretty dramatic from where we are, but actually would put the coming recession into a sort of average bucket, if you see what I mean. You know, not a very serious one and not a totally mild one, but more like we had in the early 90s and in the early part of the 2000s.
And where does that leave inflation then? I mean, has the Fed defeated the inflation dragon?
No. So what it means, I think, with inflation is that the Fed succeeds in stopping, the acceleration that's already happened. And then the reduction that we get, I believe, will be to a level that is more consistent with the rates that we had in the early 90s through the 1990s. So we average somewhere around 3.5, let's say, rather than 2 or below 2. And I think the reason we end up with that environment is because I think while the Fed has been talking very tough on inflation for about 6 months, once the economy begins to weaken, it will have to put its focus a little more on the other mandate, on the employment mandate. I mean, for now, there's no issue because employment is super red hot. Levels and unemployment rates and all these indicators point in the direction, consistent with having a tight policy to deal with inflation. But as we go through the year ahead, I think those dual mandate objectives will come into some conflict with each other. And, we'll still be seeing an inflation rate well above 3. And but depends which indicator you look at, but my current CPI forecast for the end of this year on a core basis is 4.25. And I'm assuming the traditional relationship between core PCE and CPI gets restored of about 0.5 point. So that takes you to 3.75 on the core PCE. That's probably enough with the economy weak for the Fed to begin to ease. It does leave you with a dilemma, however, that you haven't restored the sub 2% number that you were, or the around 2% number that you were so interested in doing.
I mean, and then does that lead to a question about the Fed's credibility?
Well, I mean, to me, for an institution that's messed up so much consistently over the last few years, I'm not sure, how you measure. There's no credibility monitor here. I mean, I think what it tells you is that, the likely appropriate blend viewed through the prism of the board sitting there making decisions is, we'll accept some inflation that's a little higher than we're used to having, to have an economy that kind of holds in there as we go into the early months of 2024. Now, I think that's the way to think about this whole inflation process is, we were in a very nice place of low and stable inflation for 20 years plus, and then they screwed up by pushing us out of that. And now we have to pay the price of that, and that will be a mild recession. But there's no chance anytime soon of returning to the price stability environment that we had, between between the late 90s and the mid 2010s. Because now expectations have fundamentally shifted up. We now have a generation of people who are used to inflation that they weren't before. And I think that's a loss, but it's happened, and make the best of it.
I mean, is there a chance that we could return to the 70s or the 80s in the sense that we haven't controlled inflation? It ends up being 3%, 4%, might go back up to 5 or 6%. So surely it's better to just completely bring it down so that you don't have to worry about unanchored expectations.
Well, I'm not sure if it's bad. I mean, the best would have been not to create in the first place, but now we've done it. It's a case of how do we manage the second best. And I think my assessment of the most likely outcome is, as I say, the desire was to make sure we got back well below 5. But once we're back sort of into the 3s and the economy is weak, then I think that the trade-off will be to accept that policy has to ease to provide some support to the economy. There are various other. To me, the way to think about inflation, it's not a very complicated process. At one level, it's all about shifts in relative demand and supply. And the big change of the last few years is we've had these consistent negative supply shocks. the demand picture was initially to boost it, which was the worst thing you could do, and then to cut back. Question I've got, as far as the inflation outlook is, how much in the way of more negative supply shock will we get in the next couple of years? I'm basically assuming we're done for now. But if the world geopolitically falls apart even more, and as a result of that, for example, in the US context, the dollar falls apart, which I don't think is inconceivable. It's not most likely, but it could happen. Then that could be very bad for US inflation, from a sort of secular standpoint. But for now, I'm just assuming, projecting that we get back towards that old normal, but not quite to the level where we can suddenly reestablish those nice conditions that we had, where literally inflation wasn't a concern. It was only a concern to some academic economists who thought somehow it might be too low. But if you take those out of the equation, for most people in the economy, inflation was a non-issue, and we blew it, basically.
Mm. And in terms of the Fed in this context, currently the market expects the Fed to go up to around 5 and then to start cutting rates in the second half, by 150, 200 basis points into 2024. What's your profile look like, your expected profile for the Fed?
It's similar, but basically I'm assuming they take a bit longer. So in other words, we get to, that 5 1/8 peak, which is what the Fed's been talking about. I think that's justified. But then rather than cutting straight away, I think they'll be on hold until frankly, the early part of 2024. Now, I think that view is conditional on weakness, but not disaster. So in some sense, what I'm assuming is that it's the old-fashioned business cycle where, you're actually going to have some debate for a few months as to whether we're in recession or not. I mean, I actually worked at the New York Fed briefly in 1990. In 2000. Get my decades right.
Getting your recession's wrong. Wrong decade recession.
Yeah, but during that time, up until 9/11, there was a high degree of conviction within the institution, not amongst us in the foreign department, but in the domestic guys, high degree of faith that the economy wasn't in recession. Because it was, retrospectively. So, when you get these mild downturns, there is actually an active debate that goes on for a few months as to whether, within the FOMC and beyond, as to whether you're actually in a recession or not. And I think that's the sort of discussion we're going to start having from the middle of the year through the second half. And then by the time we get, as I say, to the early part of 24, I think there'll be enough of a consensus that, yes, it's time to begin to ease. Markets will, of course, long anticipated that, but I would argue that pricing today is a little too aggressive for the second half of this year.
And in terms of potential upside risk to growth, is it possible that we don't have a landing this year, that we just end up with positive growth sequentially quarter on quarter, and this turns out to be fine? What we'll put it another way, what could lead to that outcome? I mean, in terms of all the factors that you look at.
Yeah, no, it's certainly possible. I mean, one of the problems that we've got is that the growth data seem to have fallen apart in quality, just at the very time we need to rely on them. I don't believe that the economy contracted in the first half of last year and grew nicely in the second half. Seems to me the exact opposite, but or not contracted at the end of the year, but certainly was stronger in the first half than the second half, I think. So it's a bit of an issue. Maybe in 5 years' time we'll get all the GDP revisions and it'll be clearer again. But I think in the near term, there's some concerns about, quite what some of these numbers are telling us. Now, having said all that, that means blend the data together and look at supply side data, look at labor data, as well as demand side data. And I think, what we could see happen, an alternative to my recession view, is we just kind of hang in there at a reasonably sort of sluggish, below trend rate. It's not a recession; it's sort of almost like a feeling of sluggishness. But I think all that does is it just builds up the pressure for 2024, and at that point, we moved down. I remember, going way back. I remember this atmosphere developed in the late 80s, early 90s. The Fed had raised rates. We had the stock market crash, then we had the rebound, and the Fed had raised rates into 89, and it was all a matter of waiting for the recession to unfold. And it took a year, well over a year, from the peak in rates, I believe, to the recession unfolding. So we've certainly got precedent for that.
And one potential upside risk is China. We've had this earlier than expected reopening, quite dramatic one as well. I mean, it seems like they've gone from zero to fully open, contrary to what a lot of people are expecting. They seem to have eased up on some of the restrictions on property and tech sector and so on. So there seems to be this shift going on in China. From your perspective, number one, what's your expectations for China now? And then second, what does it mean for the world?
Well, I've made a pretty big change in my China view in the last 2 or 3 months, going essentially from a world where they were growing around 3.75% in both 2022 and 23 on a sequential basis through the year, to one where 22's ended up weaker. I mean, we were actually at 2.9, I think, in the end, so it wasn't quite as weak as I thought. But 23 on a Q4 basis will be something like 7.5, 7.75. So a 3 to 4 percentage point increase in activity in China relative to what I was thinking 3 months ago. Now, that's got nothing to do with monetary easing or fiscal easing. It's everything to do with a reopening of the economy. And obviously, I'm sitting here in the US, and I'm reading stuff and seeing stuff about what I think is going on in China, but I wouldn't say I know exactly. It's hard to be 100% clear. But it seems to me the real story here for China is something we've seen everywhere else now. It started in the US, and we saw it in Europe and Japan last year, which is this normalization of the service sector, normalization of service sector demand. And associated with that, I think more goods absorption back in the domestic economy. So what's really going to happen here is that Chinese demand will strengthen significantly, consumer demand, the saving rate, which has gone up, the household saving rate has gone up appreciably in the past year, will come back down again, kind of mirroring what happened in the US in 21 and 22. So it'll be very good for Chinese demand, very good, I think, for suppliers of services in China. I think it will also be good for commodity producers, because there will be a demand for product within China. There'll be a reallocation of Chinese exports. One of the remarkable stories of the pandemic was that as China slumped domestically, it was able to reorient its production into the global market. Very, much better than anyone else. Surprise, surprise. So that supply will be reabsorbed into the domestic market. So you'll get good growth numbers, but the real benefit to the rest of the world, will be somewhat more limited, because much of the spending will go to Chinese service producers. But those that will also benefit outside of China will be the commodity suppliers. So we're talking Australia, Canada in the DM world, Brazil, Chile, and a few others, including, being brutally honest, Russia as well. China's going to be important to keeping Russia afloat in the year ahead.
And does Chinese growth, from the sounds of things, you don't think it will have much impact on US growth?
No, I mean, I think it's, all the time China is becoming a bigger player globally. But I think one of the ironies of China's sort of geopolitical approach is that they're actually going to spread the wealth, as it were. This is not, I mean, in some fashion, the bigger role that China played in the US growth story was in the past couple of years, when it was willing to supply product to help keep the US economy improving, and actually in some sense take the pressure off US inflation. Now, going back to the US inflation discussion, you could say, to the extent China's pulling more of this product back in, and they'll see a big fall in their trade surplus as a result of that. One of the aspects of that is that goods pricing for the US may become a little less cheap than it's been in recent months. I think we have actually just passed the low point in US goods pricing, to be honest. It's it will continue to be soft, but we won't keep going down at the pace we're going down. And the important aspect of that is the China story. But I think it's very sorry.
Yeah, I was going to just sorry to interject, but how long do you think the reopening growth impulse will last for? Because there's a lot of debate now within markets, around, okay, have we seen the big growth story, or will it have momentum into Q1, Q2 as a whole?
Yeah, I must admit, I've had a lot of discussions with clients and colleagues, competitors, let's call them, people like yourself, on issues like this, where, the dynamic I think I've convinced myself of is that, the Chinese people are relatively cautious about this reopening. So, they are not, it's not sort of like parts of the southern US where everyone rushed out, day one they were allowed to get out and go crazy. There's a lot of caution here. And I think that warrants, that counsels against Q1 being too strong, as it were. There will clearly be a rebound from Q4, and there's good things happening with the new year and people's willingness to travel and things like that. But to me, this is really a Q2, Q3 story. Those are the quarters that I think, will show the most robust growth in service activity. And the best way of tracking that, it's not that complicated, is every month I draw my chart updating the trend in retail sales versus industrial production. And, for the decades, well, a decent period after the mid-2000s, retail sales growth far exceeded industrial production growth. This was an economy that was gearing itself more towards consumption than production. And then that relationship flipped in 2020. And for 3 years, we've seen a big negative differential. As it's become it's become a supplying economy more and more. And I think what we're going to see, not just for the next few months, but for the next couple of years, is a flip in that relationship back again to a much stronger consumer.
And staying in the region, you've been looking at Japan a lot. I've noticed in your reports, and you've been quite adamant that they have an inflation problem. They need to make some adjustments. So we've had some policy changes by the Bank of Japan. In December, they widened the YCC. More recently, in January, they didn't do anything. Their commentary doesn't seem to say that they think they have an inflation problem. What's your view on this?
Well, I don't know if I call it an inflation problem or an inflation solution. I mean, they've in a sense set themselves a set of conditions to be met that say, yeah, we've done enough to, get rid of these extreme policies, which, I think the policies have been extreme. And so I think what's going to happen as we go through the spring is, especially under a new leadership, and I think that's a very key point, Kuroda is, surprise. Through most of last year, I was saying they're going to have to lift the ceiling on YCC in Q4. And I got to November and I'd been so beaten up by being wrong on that view that I changed it, which is, what a ridiculous thing to have done, 1 month in front of when they did actually change it. So
I think everybody was wrong-footed by that, to be honest. So
yes, at least most people who are wrong-footed was saying it wouldn't happen ever. Whereas
that's fair. Yeah, you were calling for a while. Yeah.
I majestically managed to change my view at just the wrong time. So, that's a story of my life. But I think the more important point here is that he's been very reluctant to make changes, but kind of I think eventually forced to make some. But his successors, in terms of the new team, I think will be much more willing to adjust policy to a more, what I would call a more sustainable basis. And I liken it a little bit to moving from a fixed exchange rate to a floating exchange rate. I think Japan needs to get back to freely functioning fixed income markets. They can set the policy rate where they want and everything else adjusts. There's many issues to discuss with Japan about, for example, whether, at some point they'll ever do QT. And I think that's a very premature discussion to have. I think much more likely it will be a move away from negative rates. I wouldn't be surprised, frankly, if Kuroda does that at his last meeting to leave a clean sheet. But I think the successor will do it quite quickly. And we'll see the wage condition met. That's an important inflation condition. Everything else, I think, on the inflation side is falling into place. And here's the really important point on Japanese inflation. It's not that it's out of control or anything like that. It's just, I think they've been told very plainly by both the markets, but especially by their population, that actually trying to get and keep inflation above 2% is not a good idea. It's not a desirable situation. And in fact, you could say, you could almost imagine the Japanese coming to the US and saying, you guys just sold us a bad bill of goods. You told us if we did this, everything would be great. And then you told us that we needed to get inflation above 2 and keep it there because that was the magic solution. And as soon as you did it, you said it was a stupid idea. And now what do we do? So I think there's a general disaffection with manipulated and managed bond markets, which is a very, I think from a market perspective, a really important point. We're entering a decade where the whole disaffection with QE makes the outlook for central banks very different from the last decade. If I was a central banker, I would know that most of what I have to do now has to be done without the tool of the balance sheet. I've got to think about just having rates again. And, I can hope that I can use the balance sheet, but in most cases, it's no longer a viable option. And when it comes back to Japan, I think that's a factor that the new team will have to factor into their thinking.
And on the inflation side, are you surprised that inflation didn't go higher in Japan? In Europe, we reached 8, 9, 10%, US as well. Even Korea was pretty high as well, Australia. Yet Japan didn't really go up that dramatically, despite massively weak currency, oil shock, the whole thing.
I think there's 2 or 3 things going on here. One of which is they obviously didn't have as big a energy shock as most other places. I mean, Europe stands out on that front versus everyone else. And in some ways, Japan's main shock, ironically, has been a food shock. When you look at sort of how a lot of the goods pricing has fed through, it's been through the food channel. But I think the other point on Japan is I think there are lags involved here. And I think we're beginning, if I look at the inflation dynamic developed in Japan over recent months versus everywhere else, Japan's still going up, whereas everyone else is kind of rolling over, to different degrees. And you could say, well, some of that's the currency, the lag effects of the currency. But even then, I think you're seeing more later inflation in Japan than frankly, I would have expected, and certainly more than elsewhere. So I think what you're going to see as we go into I think it's a general point, actually, as we go into the early part of this year, you're going to see some annual price resettings, which will catch up to some of the inflation we had last year. And in Japan's case, that's possibly the first price resetting in 20 years. In many other places, including in the US, it'll be, I think possibly a shock on the positive side when it comes to core inflation.
Yeah, no, that all makes sense. Now, if we move back towards the West, the Euro area, lots of people were looking for a sort of a deep recession because of the energy shock. It looks like, we've had a mild winter in the Eurozone. Numbers are starting to stabilize somewhat. What's your view in Europe or your area to start with?
Yeah, no, I think, that's definitely a case. If I, again, go back 3 months, and I had a narrative of China stable and sluggish, and Europe first into recession. And both of those views have changed. And the Europe story is precisely that the big supply side negative, which I expected to play out to cause the downturn, didn't materialize. And I think, it's interesting to try and figure out how much that was weather, and how much that was agile EU policy, which sounds an oxymoron, but it's the case, and the ability to both suppress demand through informal rationing, but more importantly, perhaps to generate inflows from other sources, natural gas inflows from other sources. I mean, I think that turns out to have been quite impressive. So I think the bullet on Russia has been dodged for now. Although, by the way, one of the things that I think is kind of very important about this whole past year is that Russia has exerted a big negative shock on the region. It's just affected parts of the region that were doing well the most, Central and Eastern Europe, but also Germany, and actually had least effect on what we think of as, for the past decade, the weaker countries, the Italies and the Spains and the Portugals and the Greeces. So actually, ironically, it's from a sort of Euro stability standpoint been a positive shock. A less negative shock than it might have been. So I'm, definitely of the view that the cyclical downturn from Russia is, the forces are there, but they're not enough to tip you into overall recession. On the other hand, that leaves you with the ECB, and the ECB is now, you talked earlier about how things have shown up in Europe that earlier showed up in the US. And just as the inflation process took longer to feed through in Europe, so the tightening process has taken longer to feed through in the Euro area. But I think of it as significant and well underway, and enough eventually to produce a downturn in Europe milder than the US, but a downturn in Europe as we go through this year. Now, do I have great conviction with that? Probably much less than the US downturn, which is one of the reasons I have it as a milder downturn. But I think, we've got fiscal neutral, possibly expansionary, but less so now because the lower gas price means there's less need for support programs. But the monetary tightening on three grounds. Number one, rates, which matters. The delta on European rates is pretty significant. By the time we get to the middle of, I've got the ECB at 3.5% by the middle of this year. So, 400 basis points on policy rates, and then spread increases across the board when it comes to actual lending rates. So there's that effect. There's the balance sheet effect, which, is more significant in Europe than it's going to be anywhere else, because not only are they beginning to do some QT, and everyone's doing modest amounts of QT, nothing big there anywhere really, but what they're doing is big drawdowns on their lending to banks through the TLTRO process, and that's going to tighten bank lending standards more aggressively than any other form of central bank balance sheet behavior, as far as I can see. So that will permeate through and add. And then the final thing is of course the currency. So of course, I think the currency, will appreciate further. I think the forward interest differentials will narrow. We talked earlier about people beginning to see Fed easing just as the ECB continues possibly to do its last hike. And that narrowing, I think, will cause the euro to probably end the year closer, 120 or so. You're the FX expert. So the combination of those three, I think, is enough, independent of whatever happens in Russia, etc., which I don't think is going to get solved anytime soon.
And this sort of threefold monetary tightening, does that also then mean we could have a sharp easing by the ECB? So they go up to 3.5, and then they, quite soon after they have to start to cut rates.
I think, maybe I just don't have much imagination, but I think what's going to happen as we go through 24 is a fairly coordinated monetary ease across the world. Again, it'll be a case of first in, first out. So in fact, the first easing is already occurring in the EM world, and that'll continue and accelerate as we go through this year. Then it spreads to the sort of what you might call the Anglo world. And then, with a lag, it'll permeate Europe, the Euro area. The notable outlier in this process will be Japan, which will have hiked into the early part of 24 and will probably stay there, in my view.
Yeah. And what about the mother country, the UK?
Not good. There's famous famous, Reagan-Gorbachev discussion where, Reagan says to Gorbachev, can you describe your economy in one word? And Gorbachev says, good. And Reagan said, well, what about two words? Not good. So I think I'd use the two-word description, which is no. I mean, I think the problem here is that it's the one country where I would identify a little bit of unanchoring of expectations on inflation, primarily through a labour market that has got some big issues. I mean, the amount of you're living this, but the amount of sort of daily strikes we get and the pressure for higher wage increases seems to me to be fairly unusual. Certainly compared to anywhere on the other side of the Atlantic. And I think the economy is doing badly, but not badly enough to compensate for that effect in the short run, if it means to offset it. And he'd say, well, okay, what's the driver behind this? And I think I have to keep coming back to the idea that Britain has this extra negative supply shock that no one else has, which is our beloved Brexit. And I'm sufficiently old-fashioned and versed in sort of UK underperformance that I've got all these comparisons, and to me, Brexit will go down as a very similar policy mistake to going back on gold in 1925. It created 6 years of massive underperformance before everything fell apart in 1931, and we're in that same environment now. I think it's hard to project the medium-term outlook to this. I mean, you can be very bullish and say ultimately everything will turn around and there'll be a lot more external focus and all that. But I just worry that in the near term, it's just a very, very grim picture.
I'm very sympathetic to that view. But then what does that mean for the Bank of England? I mean, they're in a tough bind. They seem to want to be very dovish, yet they don't have enough help from the inflation side, you could say, to allow them to be dovish. So what are they to do?
I think they just chip away at those 25. I mean, they'll do 50, I think, next month. And of course, we're in this process where central banks have been quickly lifting rates to what they perceive to be neutral values. But I think from that point, having done 50 in February, the bank will be biased towards doing 25s. But I think the key here is that they're trying, it's almost like a process of price discovery. They're trying to understand what the neutral level of rates is, or what the damaging level of rates is. And, the discussion that we had in the markets over the last 2 or 3 months, was effectively the bank staff, the governor allowing his chief economist to take over in some sense, and the bank staff saying, we think the neutral rate is a lot lower than the market thinks it is. And that battle of wills is sort of playing out. And to be honest, what's happened is we're getting convergence in the middle. The bank's having to raise its assessment of where neutral is, and the market's come down on its assessment. And I think that means we settle. I mean, I've got the bank peaking at 4.5 in the middle of the year. So that's probably not far these days from where the market's priced. And I think the bank's point was it's not above 5, and they're probably right in that, but it's above 4. So that's where I'm.
And we've talked about some of the bigger economies now outside, whether it's EM or the smaller G10s. Is there anything else that sounds out for you? Any observations?
Well, I think there's some interesting pairwise discussions in the in the DM world. So, for example, I think we're in another one of these worlds where the Swedish are having an extreme cycle, and the Norwegians are your sort of low heartbeat economy and central bank. So there's going to be a lot of action there. Sweden probably overshooting on the rate side on the high side, as Norway is much more gradual, and then on the down cycle, a lot more sort of aggressive easing. And the same pairwise relationship, I think, holds in New Zealand, Australia, where the RBA is a much more steady, adjuster up, and the RBNZ's been much more aggressive. And once everything tanks, will probably end up being much more aggressive on the downside. So it's kind of like the tortoise and hare relationship there, I think, is quite important. And actually, sort of behind that, there's a little bit of a message here, which is that if you're a big oil and gas producer and resources producer, and the negative shock you face from an income perspective is far different from if you just import all the stuff. And so, ironically, your inflation pressure is probably less than if you're totally dependent on imports of this stuff, because in effect, your negative income shift is much smaller. So you don't have to ration the demand amongst your domestic economy in quite the same aggressive way that you do if you're in the UK or the Euro area. So I think that's an important kind of point to bear in mind. And then just generally coming back to EM, I would say it's actually a pretty good environment for EM. I mean, there's a huge amount of political oddity going on in EM. And the two obvious cases are, the extreme one is Turkey, which I would stay away from personally, but that's. But Brazil, I think, is interesting, because I think we're kind of facing this. Is Lula 3 really similar to Lula 1 and 2, or is he a complete crazy who's going to blow everything up? And I think the market is very uncertain at the moment. My bias is to say he'll be like Lula 1 and 2, but everything he's done in this first 2 or 3 months, or first month in office and month before that, has rattled me a bit. So I'm kind of a little more nervous about that. But I think generally the EM world is looking pretty good as we go through the next year. And some of it's China, some of it's natural cyclical leadership, ironically. So instead of responding to the Fed, they led the Fed. So we're at the point in their rate cycles where there's pressure to ease. And what can get in the way of those two positives? And by the way, a weaker dollar is an important backdrop to this. So those positives, what can get in the way of them is domestic stupidity and poor policy setting, which many of them seem to have a capability of being able to do.
Yeah. And then, so overall, in terms of, if we switch over to market implications, I know you tend to be more kind of in the weeds on the economy, but, you talked about a weak dollar view, more of a positive EM view. In general, for equities, would you have a view on equities?
Yeah, I suppose I'm, frankly, just a bit negative, because I think where we sit now is the equity market has enjoyed the downside of interest rates without realizing that that's a leading indicator of a massive slump in earnings. So I think the earnings picture is as we go through this year, going to be a lot more negative than the market currently accepts, even after the downgrades of recent months. So that's my reason for some caution on the equity side. I think the US versus non-US trade is interesting, because for once in a long time, we do appear to see some attractiveness to non-US equities relative to US, which is a mixture of valuations, but also with these relative fundamentals, including some of the dollar messages. And the EM equities, I think, look to me, relatively attractive. Obviously, China's made a major move, but there's plenty more upside there if you really think China's going to be, as strong as I think it's going to be.
And bond yields, anything? Will they just kind of go sideways because we have?
The problem is, to me, there are two narratives about the bond market. One is this sort of cyclical story, which is a very powerful one, and it's probably going to dominate the next year or so, meaning a little bit more on the tightening side, but then an easing cycle comes into view. And bond market, that's a bit like being at the top of a snow sled with a nice fresh fall. Everyone wants to slide down that one. The secular story, I think, however, is important, which goes back to that earlier discussion about the medium-term trend to inflation. But then on top of that, I would say that there's a really important issue here, which goes back to something I've alluded to a couple of times, which is this very different world facing central bank balance sheet management. And in a downturn, as I think we're going to get, we're going to see widening budget deficits. Not necessarily dramatic use of fiscal policy, but just wider budget deficits on a cyclical basis. And the last two times that's happened, we've had a massive increase in central bank buying to more than offset that effect. This time, I'm pretty confident that what's going to happen is that as deficits widen, central banks will actually be adding bond supply, to the market. So the sum of the two keeps going higher. So I think that has to raise term premia, or at least some pressure on bond yields to be higher than they would otherwise be. So to me, that's from a more of a perspective of 24 and 25, perhaps, that makes me very cautious about DM bond yields generally, but especially in the US, UK, Japan, and Europe, where you can. I mean, what's fascinating is you've got Japan out there at 100% of GDP QE, and the others in the mid-30s, and then everyone else trivial, and it's those the three in the 30s, the UK, US, ECB, and then Japan, who I think face this, this dilemma. In effect, it's like a secular unwind of the post 2010 QE effect.
Yeah, well, that's something to look forward to, or not to look forward to. Sounds quite sort of scary prospects as we get through the recession, and we have to worry about that. But no, that's great. I mean, we could go on and talk more about markets and the economy, but I did also want to ask you some personal questions, which I always like to do. One was, have you read any good books or good academic papers or anything? Has anything stood out for you recently?
Well, I must admit, I live in DC part of the time, and right next to the National Gallery of Art, and I've recently become obsessed with Andrew Mellon, and I read this fantastic biography of Andrew Mellon by a guy called David Cannondine, who's actually an English academic historian, and the guy is absolutely fascinating. Not the least of which is he literally gave his art collection to the country and provided all the funds to build the National Gallery in Washington.
Oh,
okay. And it should have been called the Mellon Gallery, of course, if there was any justice in the world. But he didn't want that. He just wanted it to be called the National Gallery. And by the way, when he did this, he was Treasury Secretary. and there are so many interesting angles around this guy. I mean, he's one of your classic robber baron capitalists, but somehow came out of it better than all the rest of them. Better than, dare I say it, the JP Morgans. And
okay, yeah.
So yeah, I'd really recommend getting to know Andrew Mellon a little more. He's a fascinating character. This book,
yeah, I'll add it to my reading list. That sounds great.
It's a big book, but yeah, it's worth it. It's good.
Yeah. And then on the TV movie side, anything you've seen good recently?
Well, I'm afraid, I'm a follower and a leader on a lot of this, and of course, I've become, like everyone else, obsessed with this show White Lotus, which I think is a fascinating show. But my favorite one of recent months has actually been the Welcome to Wrexham. I don't know if you're familiar with that.
Oh, yeah, with the Ryan Reynolds one.
Yes, and I've actually become a surrogate Wrexham fan, and it's a very interesting story.
So, for the benefit of our listeners, can you tell them a bit what Wrexham is and what happened, just briefly?
Well, it's a soccer club from North Wales, right, just really outside Manchester, but over the border into Wales, that sort of suffered the ignominy of just falling, as in line with their town. Their town was a steel town that just kind of fell into despair over a 30-40 year period. And with it went the soccer team. And then in come these two Hollywood guys, buy the team. We're not talking about Etihad and Manchester City or something like that. We're talking about modest amounts being put in, and the beginning of of a resurgence. And you can see the great thing about this show is they show not just the resurgence of the soccer team, but the resurgence of the town. So it's actually very, very heartwarming. I got a good friend from my school days who actually lives in Wrexham, so that makes it even more.
And speaking of football or soccer, what were your thoughts on the Football World Cup?
Well, actually, here's the amusing thing: is we all went in saying, "Oh, terrible idea of holding it in Qatar, terrible idea of holding it in the winter," and I actually thought it went rather well. Everything about it was pretty impressive. So yeah, and good luck. And I was very pleased. And of course, shame England didn't. We had the usual of missing a penalty, which was our usual ritual of going out of the World Cup. But after that, I was actually very pleased to see Argentina and Messi win.
Yeah, I thought it was a really nice World Cup in that respect. Very exciting, lots of great sort of sub-storylines. Morocco doing really well, and some of the big teams getting knocked out early. Spain, Germany, and so on. So
I think it was globally a very good competition. So yeah, well done all round.
And then on the Premiership, Arsenal top of the table. Is it the end of Manchester City and Liverpool are doing terribly?
Well, no, I suppose my takeaway from watching probably too much of it is how even the division has become. I mean, I think Arsenal, are something special this year. But, I'm just struck. You see teams that you never thought would survive, all of a sudden, competing for European spots and things. So it's, in some ways, it's a sad reflection of the excess money that, if they could divert some of this money from the Premier League into the broader economy, maybe the country would be a bit better. But for now, it's very impressive to see the breadth of strength of the Premier League.
And how's your Luton doing, by the way?
Well, unbelievably well. I mean, the Championship, which is the next division down where we are, looks like it's going to be run away with by Burnley, and then next to them is Sheffield United. So everyone else is competing for that third playoff spot, and we're in the mix in a way that I didn't expect. So yeah, a very good.
Fingers crossed, you could be in the Premiership next season.
I think it would be a disaster personally, but anyway.
No, that's great. With that, it's great as always to talk to you. I do urge people to reach out to you and get hold of your research. I do continue to believe that you write probably the best economics or global economics daily in the market. What's the best way for people to reach out to you?
Well, by far the easiest way. I mean, we do have a website, but I would just say reach out to me at phil@subtleeconomics.com. And if you've got any appetite to see what we do, thanks for the advert, Bilal. I mean, it's very kind. But seriously, the best way of seeing what we do is literally having it for a while and seeing if it's any use to you. And as I say, it's phil@subtleeconomics.com.
Yeah, and again, I do urge people to take a look at it. It's very, very good. So with that, Phil, thanks a lot as always, and good luck with all your views and your forecasts for this year.
Thanks very much, Bilal. Likewise to you.
Great. Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.